last year during Voyage, we discussed our view on growth quite in detail. Few things have changed since then and few haven't. Of course, as we expected that the large oil stimulus that India received because of sharp fall in oil prices and in the large monetary stimulus would result in some bit of an uptick in consumption, and it did happen. When you get to see a lot of crowd in airports, and there are large queues to buy Maruti cars, all this is reflecting of very, very strong urban consumption. So we are fairly certain that since last year in April when we met, urban consumption has picked up and has gained a lot of momentum. But what didn't change over last 1 year is something that we were circumspect of, and that is the investment. Dr. Subbarao did allude to this, that this is our medium-term risk, and unfortunately, India continues to struggle with the very, very lowish level of capex. Why is it that despite a reasonable amount of turnaround that we get to see in consumption, the capex has not come about? I think it's mostly to do with of course excess capacities, but also that we have this twin balance sheet problems in our country. The banking balance sheet continued to get strained because of NPAs, which originated maybe in 2007 and 2011, but our banking is actually sitting on large amount of gross NPAs. Also, our corporates are fairly levered. If you look around in Asia and even developed markets, very, very few corporates, very, very few countries rather have such high amount of indebtedness in the top corporate. So these are the two big reasons. The capex hasn't come about in India, and unfortunately for us to have any durable gain for our growth for medium term, capex has to turn around. But what did change over last 1 year, and in some sense it's been a secular downtrend as far as inflation is concerned. People who were in 2011 and 12 tracking markets would remember that our inflation was very, very high. Some measures of inflation were tracking teens. That has been coming off quite secularly. Over last 1 year as well, our inflation numbers have come off. The core inflation, which is a true measure of the inherent demand-supply gap in a country, has also been coming off quite secularly. The core inflation, which actually removes the jewelry and oil component of core inflation, has come down by about 60-70 basis points over last 1 year. So unlike many expectations by economists and strategists and some of the regulators last year, I think inflation has been surprising on the good side of it for last 8, 10, 12 months. The good thing is that I continue to remain very, very confident that India's inflation would kind of move down over next 1.5 years as well. My big confidence does come from the fact that there are two big reasons which would still help India disinflate further. One is my long-held view that India's real estate or property market is in a bear market. I've been of this view for last 2013. For about 3.5 years, I've been talking about it, and many of you would recollect. But this would be the underpinning of a further disinflation in the core side. If you look around the world, historically as well, almost everywhere, wherever the property prices actually kind of deflated or came off, it always resulted in a lower consumer inflation. So I think something similar would continue to play out over next couple of quarters. The other thing, of course, is that many of us who are monetarists, who believe that inflation is always a monetary phenomenon, must look at the banking balance sheet. Many of us know that the banking credit has not been growing very rapidly. It's actually very, very tepid. FY17 credit growth was just about 5%, which is another reason why inflation wouldn't really come back, and most probably country would continue to see a lot of disinflation in times to come. So bear market in property and very, very tepid credit growth, which would in turn create a lot lesser money, so to say, versus what we have been used to, rather, would kind of ensure conditions of further substantial amount of disinflation in the times to come. Now, of course, what has happened over the last 1 year is that interest rates have come down. If you remember in April when we were talking in Voyage, the rates were closer to about 7.5. We were just coming out of a period when rates had backed up quite significantly, and there were many commentaries even then that interest rates in India would be sticky and wouldn't actually be coming off. Instead, what has happened, of course, is that RBI did cut rates, and interest rates in India actually kind of come off quite significantly over last 8, 10, 12 months. Though we are aware that RBI has actually put a pause to the rate cuts right now and have changed their view. They actually moved to neutral. At least internally, my team and we believe that it's been somewhat premature, given the low capacity utilization, a very, very bad condition as far as capex is concerned, and a kind of a secular disinflation that India has experienced over the last couple of quarters. I think it would have been apt to keep the degree of freedom with respect to cutting more further interest rates. Nevertheless, really can't fight a central banker. At this point in time, it appears that the interest rates wouldn't be brought down over the next 3 to 6 months' time. But given the general consideration on growth and inflation, our core view remains that next year when we kind of meet again in Voyage 2018, we would see interest rates coming off further from where they are right now. Now, I'll take you back to 2015, when we discussed about the general philosophy of investing across our funds. I discussed in detail as to how we managed our various category of funds, including duration and liquidity. I also alluded to how we manage credit funds at that point in time. That point in time in 2014-15, credit funds or the corporate bond funds were still very, very small part of our AUM and industry's AUM. But since then, this category has actually taken a big lift, and it's become a very, very big asset class as such. So maybe it's apt for me to kind of explain and demystify for our investors and intermediaries and everyone who is involved in the market as to what are these funds. How exactly credit funds are managed. Are they the same across fund houses and fund managers, how they manage them, or there are differences across them? So here, over the next couple of minutes, I'll try and explain to you as to how a variety of fund houses and fund managers are actually looking at this asset class. If I were to pool all the credit funds together, it'll become a 1 lakh crore or thereabouts of a total size of a fund. How are they distributed in terms of rating? Typically, these are invested in A to AAA in terms of rating, across spectrum. About 40% of this large credit pool is invested in AA rated papers, and about 40% in A rated paper. So that's in a nutshell how the broad portfolio from a rating standpoint look like. Of course, since 2013 and 14, there has been a lot more infiltration of credit. In a sense, the A-graded paper percentage of AUM has actually gone up to a certain extent, but that's more to do with the cyclicality of it versus general biases of fund managers. These funds, are from a sectoral standpoint, are predominantly invested in NBFCs to the extent of about 30-32%. NBFCs and financials all put together is about 30-32%. About 6-8% is invested in energy and metal. And then there is a huge tail of diversified set of companies that these funds tend to invest in. If you were to compare these funds with banking, banking predominantly invest in agriculture, retail and personal loans, and also within industry it does lend to a lot of services, metal and energy. So the fund allocation and the banking allocation are very, very different. We'll try and talk about it as to how funds are actually meaningfully different from banking, because banking generally is struggling with a lot of stress, whereas MF portfolios have done reasonably well. So there are reasons for them, and we'll talk about it. But here, just to kind of differentiate that the portfolios of funds as well as and the banks are actually very, very different. These funds typically have run about 2 years of duration. They've kind of oscillated a few months here and there in and around 2 years over the last couple of years. Over 5-6 years, on an average, it's been about 24-26 months of duration. So that essentially means that these funds don't necessarily run a substantial amount of duration risk, and therefore, even in times when interest rates back up substantially, these funds don't necessarily give negative surprises. Recently, when rates backed up by a good 60-70 basis point in India, most of the credit funds actually recouped in a matter of about I think 1 to 2 months, depending upon the duration they were running. I think something similar happened in 2013 when RBI lifted rates by 3%. These funds actually recoup all the losses in few months' time. So essentially, the point is that these are an outright carry funds, and frankly do not pluck much from the duration in terms of the returns that they kind of profile. But interestingly, in India, these funds are able to capture more or less the entire term premium, because traditionally in India, from 3 months to 2-3 years is where the maximum term premium exists. After that, curves tend to get somewhat flat. At least historically, this is what has happened, and which is why they don't necessarily sacrifice on the term premium. So in a sense, the general point being made here that they stay away from a large duration bets, but do kind of capture most of the term premium available in the markets. As far as the yield of the funds are concerned, they run about 2% extra yield. This is on an average about for last 5 years, where the fixed deposits have been. These funds tend to earn about 2% extra over fixed deposits in terms of current yield. This is not the return I'm talking of. These are the current yields, or the carry of the portfolio as we know it. And also versus AAA centric funds or AAA bonds as such, these funds tend to have a carry of about 2%. Now this is to give you a perspective of what is a credit fund. I talked about the average duration, which is closer to 2, the sectoral allocation, which is largely into financials, energy, and metal, and finally the carry of the fund, which is closer to about 2% over fixed deposits on an average over last 5 years. And this we're not talking of right now. This is what we're talking on an average of last 5 years. These funds, of course, have grown very, very rapidly. It's already about 1 lakh crore plus industry size. I also think that industry will be in excess of 125 lakh crores in 14-15 years. Right now, this fund category is about 5-6% of the industry. It is set to become 20-25%. So in a sense, at some point in time in 2030s, I think this category would be in excess of 20-25 lakh crores. And in a sense, what we'll end up doing is that there's going to be a lot of disintermediation, even on the lending side. A large part of lending would start to happen from funds like these. So in a sense, this fund category has been growing at about 25% every year, and it's set to grow at a more or less the same pace over the next 1 decade at least. As far as returns are concerned, these funds have delivered about 100 to 150 basis point over fixed deposit on a pre-tax basis across time horizons. And it's quite likely that unless, of course, there are meaningful credit events in some funds, this kind of returns are something that investors can actually expect from a typical credit fund. Though we call them credit funds, many people in the industry will call them corporate bond funds. Some actually would call them carry funds. Some others talk of accrual fund. In West, particularly in United States, it's considered as investment grade fund, and that is actually quite a dominant part of the big investment, fixed income investment class out there. So, but in various names, but in essence, the 5-6 characteristics of this particular category of fund that I explained is somewhat common across various names that people kind of refer to. I think many people kind of keep asking me, and morning also a few people were asking whether there are enough assets in the market to underwrite, and these asset classes actually would kind of give us space in our funds and of the industry's credit funds to kind of acquire and earn reasonable returns for the investors. Finally, on the return side, of course, I made a point that most of the credit funds deliver about 2% in terms of carry, and net of expenses, they've delivered about 1.5%. Of course, our funds in last five years have kind of delivered about a percentage more over and above where the industry on an average has delivered. And to that extent, one of the reasons why we've been able to deliver is not because we underwrote at higher yield. It's just that the drawdowns for us have been non-existent. The point I made that people struggled with bad exposures like JSPL, Built, and so on and so forth, and downgrades to the extent of 4-5% of their portfolios. We haven't had downgrades, and we haven't had drawdowns because of defaults, and that's the reason why these portfolios have actually delivered a more stable and better returns.